We could see about 15 years ago that was a fool's errand. That it wasn't going to end well. And not only was it adding operational cost to us, we came to realize the value of having a unified system and a data stack that is not only all-in-one. That's the gold mine.
Welcome to the Leader's Edge podcast. I'm Sandy Laycox, Editor-in-Chief of Leader's Edge. In this podcast, I talk with Eric Leavitt, Executive Chairman and CEO of Leavitt Group, and also Vice Chair of the Council's Board. Leavitt Group is a top acquirer among insurance brokerages, rated by Marshberry as the 5th most active buyer in 2024. We dove deep into Leavitt's acquisition and integration strategy, starting with the company's recent decision to take on a minority investor and how that changed some of their approach.
We average about 25 transactions a year.
Yeah.
Many of them are smaller, that they're roll-ins that go into existing agencies, but we have an active M&A process and have do all of it in-house, in fact. Nearly all of us. We have, depending on the size of transactions, we periodically get a little bit of outside legal help, but for the most part, it's all done in-house.
And you were, up until very recently, I believe, the number one independent acquirer.
Yeah.
I know you guys took on some private capital.
We did. We took, it's still a small, it's a minority stake.
Yeah.
We sold about a 21% stake to Capital Z Partners at the end of 24. We had, they really in some ways replaced prior capital partners that weren't necessarily private equity, but they've been great partners, and the reason we did that was not necessarily for capital reasons, but for family succession reasons. Capital Z Partners have been terrific, and we're grateful to have them on our team.
Has it changed anything about your approach or strategy to have them as a partner?
It has changed a little bit, and here's why it's changed. We being largely a family-owned company, we had an ESOP that we used to incent key employees, and we've historically valued the company consistent with the way an ESOP is valued, which involves some kind of restrictions that brings the value down. And so we always use that ESOP value for our valuation. And then we could see that that it was less than the fair market value in the marketplace. Yeah. We didn't want to sell the business, but it became more difficult for us to justify increasing the prices at which we buy agencies if our internal valuation was lower. And so we needed to get a sense for what our value was in the marketplace, and the Capital Z transaction helped us establish that. And so knowing what the value of our company is in terms of a multiple of EBITDA, that helped us justify being more competitive on larger deals, to be able to be competitive from a price standpoint. We've always been competitive in other, call it non-financial areas, but there's only so far that non-financial elements go in winning the trust of future partners. And so that's one way it's helped us.
We then discussed Leavitt's operating model and how they identify potential acquisitions.
A fairly unique operating model in that it involves shared ownership of the agencies. Now, we're not unique in a shared ownership model. There are many that have that. BroadStreet is the one that is probably the most prominent in having shared ownership at the local level. So we have our operating model is that the parent is called Leavitt Group Enterprises. That's where the family's ownership is, and it generally owns about 60 or 70% of each of our agencies. We have about 275 locations and 90 separate agency corporations where we are the majority partner in each of those corporations, and then one or more we call co-owners are the owners of the minority interests. And those who hold the minority interests are charged with operating it day to day, and we deliver to them resources to help them operate in ways that they couldn't otherwise do. We have shared services. We have a common IT platform, common HR platform, common legal platform, and all of these shared services are delivered through an entity called Leavitt Group Agency Association, which is essentially, call it a cooperative, where we gain the scale and the buying power, if you will, that we can deliver at the local level, that gives them the capacity to be much like a national broker, but to have local autonomy and local control.
Super integrated, it
sounds
very, like.
Yeah, very and integration is kind of the word of the year, and was last year too. And I'm sure we'll talk a lot about integration today. But yeah, we began integrating really in the 70s.
Wow.
And we understood, I think, we understand more than we did then, but we understood the principle of aligning interests and finding ways in which this group that had aligned interests could determine what it is that they're going to invest in, and gain the scale that comes through that collaboration and that alignment of interest. So we've been at it a long time. It's hard. It's hard work to be integrated. It's a lot easier, especially if you're acquisitive. We do, as I said, 25 or so deals a year, and you just create from the start an expectation that they will be integrated in a real positive way, but also in ways in which it might be disruptive to them in the short run.
Yeah. Let's dig into that. So how do you, first of all, when you're looking for agencies that you are, what might want to acquire, how do you choose them? What are you looking for?
Yeah. For us, a cultural and relationship fit is the most important first step. Pro formas are great. How this might look from a financial standpoint is an important, and it's of course necessary, because you don't want to go into a deal that's going to fail financially. Mm-hmm. But equally as important, and arguably in some cases more important, is are you going to fit with that potential partner culturally and from a relationship standpoint? Because we really do vest almost complete autonomy on the day-to-day operation to those local people. Yeah. And so first and foremost is, are they, do they have a desire to remain in their agency for a period of time? And generally speaking, the ideal agency that we would be involved in is where there is one or more owners that are maybe 5 to 7 years prior to their retirement, don't necessarily want to take the biggest check they can get, but they want to be assured that the culture and the heritage and the history of their agency is retained. But they also want to have opportunity for younger people to buy in. So often we've seen agency owners that sell 100% of the deal, and they've got younger people who are up and coming, many of whom have actually helped them build the enterprise value. They get shut out. Yeah. And often what happens is, many buyers are very smart to tie those younger people in, but they don't have the same opportunity to own equity in the local operation. So, someone who doesn't want to necessarily sell out right away, has some runway to be able to take the tools that we will bring them and build the agency post-transaction for call it 5 to 7 years, and those that have identified one or more potential successor owners that we might work with to help them with what we call their second liquidity event, which is when they sell their remaining interest to that younger person. And we facilitate, and in many cases provide financing for that younger person to buy out the incumbent owner when it's their time to transition. So, on one hand, we win deals all the time without being the prospective buyer that brings the biggest multiple to the table, but we also recognize we have to be competitive. We also have been very effective in selling agency owners that the amount that they retain, the value that they retain by only selling, call it 60 or 70% of their agency, with working together can grow in a way that if you look at the ultimate net present value of the transactions in the first liquidity event, which is when we come in, and in the subsequent liquidity event when we have the younger people buy in, that on a net present value basis they do better than they would have had they sold 100% 5 years previous. And a lot of that is again, not everyone is in that mindset. You'll have agency owners that might be in their 70s that say, I'm tired and I want a big check and I want to go to the Bahamas. And those folks have built a great agency, but that's not a fit for us. Mm-hmm. We generally look to folks who either have some runway and want to have a say in who succeeds them and they want to continue to build their agency, or it's time for them to retire and they know who their successors are, and other buyers won't give them the opportunity. The younger people have an opportunity to own.
Integration is a key component of Leavitt's acquisition strategy. We talk about the challenges to that and the value that comes from working through it.
It's a very niche seller, as you can see. They need to be willing to not sell 100%. Mm-hmm. They need to be enthused about staying in the deal and building the deal. Again, we view that as a positive because we think that the subsequent liquidity event will in the net with the original liquidity deal add up to receiving more for your business than they would have otherwise if they sold to private equity, say. But they also recognize that one of the sacrifices they make is to create terms for the younger person to buy in that are palatable. I mean, it's not a layup for these younger people. Yeah. But it has to be at least palatable. Mm-hmm. As I said, we've been integrating since 78, but there were periods in our history when we didn't integrate from a technology standpoint into a single system. I think into really the 2010s, we were. When we did transactions, it's a lot funner story to say, you can come join us and we've got all these really good things and you don't have to migrate systems. Right. We could see about 15 years ago that was a fool's errand, that it wasn't going to end well. And not only was it adding operational cost to us, we came to realize in ways that were pretty profound then but are much more profound now, the value of having a unified system and a data stack that is not only all on one database, but that is uniform in the way it is structured in terms of policy data, customer data, industry classifications. That's the gold mine, frankly. And that gold mine doesn't come unless you are fully integrated. And we've seen, many of my friends who have been really successful in building agencies, billion-dollar agencies in less than a decade, are coming to understand the importance, and their investors are demanding. Right. If you're going to grow, we need to grow more than top line. We need to grow EBITDA too, and that EBITDA growth will come through the efficiencies that will come through integration. The challenge with that is it requires capital, and that capital won't return EBITDA immediately. It takes some time. So 15 years ago, we made the determination we'll go from servicing 5 systems to 1. And that would, you would say, well, why is that a hard discussion? Why is that a hard decision? First of all, in our model, it's hard because we very rarely dictate from the top things that are going to happen. And the things that we dictate and just say, look, these are non-starters, are usually things associated with the law. If it's illegal, we're not going to do it. I don't care what you say. Fair. But for the most part, we work through collaboration and a pursuit of consensus. So when we did our system consolidation, we got a user group together and said, look, let's all agree we need to do this. And everybody agreed we needed to do it. They could see it. It's just how and what system you came down to. It took us 2 years to determine a system.
Wow.
We knew, frankly, from the start, the system that we wanted, and we could have shortchanged that and said, okay, this is all fine and good, but this is where we're headed.
Right.
We needed to be able to win the minds and hearts of those who were going to be using the system in ways that they didn't feel pushed, because as human beings, if it's our idea, we're all over it. If it's someone else's idea, it's really challenging. So it took us 2 years to align on what we could see early on was the best outcome. So again, why is it so hard? In our model, it's hard because we don't use compulsion that much. I mean, some would argue, and I would agree, that it's a really inefficient way to run a business to go look around and ask for consensus on all things, and we don't do that in all things. But it is somewhat inefficient. But we believe that it preserves this alignment of interests, preserves the trust that we have with one another, and makes our model so special, and that we give autonomy, so much autonomy to the local folks. If you look at what's happened the last 2 years, I know there are firms that are spending hundreds of millions of dollars on these efforts to integrate, and they're wise to do it. Yeah. Without that, much of the real gold, you referred to that earlier, is really lost. And the gold isn't necessarily just financial. It ultimately gets to financial, but it's really cultural. Mm-hmm. I mean, when you have 275 offices across the United States, it's a real advantage to have your office in Boise, Idaho, feel a real kinship to the agency you have in Wheeling, West Virginia, even though they share no clients. Yeah. And we work real hard to create this sense of belonging and this sense of connectivity in ways that are manifesting itself in really positive ways, not the least of which is we're doing lots of really good work in cross-agency team-ups, and and where subject matter experts from agency A help subject matter experts in agency B, and anyway, it's a real, again, manifestation of we'll call it the financial part of a non-financial effort.
Eric then shares his thoughts on the current brokerage M&A trends.
We're at an interesting inflection point. We're seeing that inflection point manifest in some of the bigger deals that have happened, most notably the large acquirers who have been kind of subsumed by the top five. Mm-hmm. And there's, I think it's been well documented why that is happening, and I'll just note it. It's getting harder and harder for these agencies that haven't really integrated to be able to demand multiples that go beyond that which they have gotten in the past at a refinancing. And so they're facing the obligation to refinance their equity and get their current equity partners out, and they can't find a substitute that's willing to pay that multiple, because you can only grow at double-digit rates so long through inorganic growth. And so the only firms that have been shown a willingness to take on a massive integration project have been the larger, public brokers. You're going to see more and more of these larger, kind of nascent billion-dollar firms. That's
an interesting term.
How can you be nascent and be $1 billion? But we've seen it. Yeah, we've seen it. They're not going to have much choice but to either go public or to get consolidated. And there's only so much that, frankly, Gallagher and Brown and Brown and the others can do, because there is at one time, because there is a definite opportunity and transaction costs associated with that integration. Now, if you go downstream, you also need to look at the fact that multiples are leveling. And if you look at the multiples that the publicly traded brokers are trading at now, they are at, most of the publicly traded brokers this week are at 52-week lows in their stock price. Doesn't fundamentally mean their businesses are worse. It's just the nature of the marketplace, because I think these are all terrific businesses.
Yeah.
But that's going to put pressure on multiples, and it may put a chilling effect on some that we're preparing to sell, and it might, who knows, but it may put a chilling effect on the market. I don't know that for sure, but we'll see. Some would say, hasn't the consolidation nearly happened in total?
Yeah, good
because
question.
so much has happened? And the short answer is no, because every year there are new agencies created.
Yep.
And every year these agencies that are created are searching for solutions to help them get bigger. We've all been watching this M&A market for a decade and a half now, thinking, okay, now is the time when it gets less crazy. And I think the short answer is it will never get not quote unquote traditionally viewed as sane. But it's a great business, and there's a reason why capital has flocked to this business.
Looking ahead, Eric shares the exciting developments underway at Leavitt Group in 2026.
There's a very interesting, 2026 will be an interesting year for us in terms of our evolution as a company. We're forming our own MGA, and we've been very, very upfront with our key wholesale partners and just say, look, this isn't a goal to replace you. We can see that we have, we have nearly $1 billion in premium that's with a whole lot of wholesalers. But we have subject matter experts within our group that can create programs where we have specific underwriting opportunities in ways that are really valuable, not just to our clients and to the carriers, but to us too. And so we can see that taking a piece of that value chain is a wise thing for us to do, and can be done in ways in which it's not deeply disruptive to the very necessary relationships we have with our wholesalers. I saw an interesting, the Hales report had Rob Berkeley, who's a friend and is one of the great leaders along with his dad in our industry, talked about the changing nature of the relationship between carriers and distribution. And that's been happening for a while. It arguably started with carriers going direct. They may say that it started elsewhere, but then you're seeing more and more historically retail distribution firms forming or buying wholesale outlets. And so that's what we're doing. We've decided not to buy anything. We're going to build it, and it'll be unique in that, consistent with the way we do things. Our agencies will own it. The parent won't own it. Oh, nice. The agencies will put the capital up, and they'll place business into that MGA, and it will. We hope it'll thrive.
That's very exciting.
We're also in the process of kind of formalizing our effort in risk advisory that right now is really distributed. We have about 30 FTE across the group that are dedicated to risk advisory, but it's done on kind of an agency by agency level. And so we'll organize that in a way that will serve our clients better, but will also create opportunities for us to get new revenue sources. Then we're doing lots of cross-selling. I mentioned that.
Yeah.
We've embarked on a cross-selling arrangement across agencies and across lines of business that's really taken on, and we're still a little bit on the outside of trying to figure out, like many of my friends in the business are, how we can get into financial services and wealth advisory in a way that doesn't necessarily create undue risk exposures, because it's a completely different ballgame, the way it's organized, the way it's regulated, and so that may not be a 26 thing, it might be a 27 thing, but and in addition to that, we're just trying to sell a whole lot more insurance to our good clients and to acquire new clients.
Absolutely.
So, that's what's on tap for 26.
Well, it sounds exciting.
Yeah, we're excited.
Yeah.
And we're just we're grateful to be in an industry, frankly, that is honorable. I use the term noble. It is a noble industry. You think about the service that we provide those, not just those who have claims and are, in many cases at the worst moments in their life, but the enabling power of the insurance industry in terms of forward-looking economics. Anything that's built and financed requires us in the industry. We are sources of comfort and sources of protection in ways that allow people to venture in ways they may not otherwise do. And I'm proud to be in the industry, proud to be a part of it, and grateful for the role that the council plays in not just convening us together, but enabling us and empowering us in ways that are making all the member firms better.
That was Eric Leavitt, Executive Chairman and CEO of Leavitt Group. I hope you enjoyed our conversation. For more Leaders Edge podcasts, visit us at leadersedge.com.